Let's talk about what just happened to silver. Because if you've been watching the price action this week, something shifted, and it shifted fast. Earlier this week, silver briefly surged above $75 an ounce. By Friday's close, it had given back more than $2 and was stabilizing in the low $73 range. That kind of move, compressed into less than 48 hours, doesn't happen in a vacuum. It doesn't happen by accident, and it almost never has just one clean explanation, which is exactly why it's worth slowing down and actually reading the tape rather than reaching for the simplest story. So that's what we're doing today. What actually drove this move? What forces converged to take silver from one of its sharpest single-session surges of the year to a $2 correction before the week was even over? And more importantly, what does the setup look like from here? Let's start with the context, because without it, none of this makes sense. Going into this week, silver was already carrying an enormous amount of accumulated momentum. Over the course of 2025, the metal more than doubled in value, one of the strongest performances it has posted in decades, breaking price levels that hadn't been seen since the early 1980s. That kind of run creates a very specific market dynamic heading into the new year: stretched positioning, elevated speculative exposure, and a growing population of investors sitting on significant unrealized gains. Markets that have moved that far, that fast, become sensitive. Any deterioration in the macro narrative, any shift in Fed expectations, any dollar strength, any risk-off liquidation can trigger outsized moves to the downside, not because the fundamentals changed, but because the positioning had gotten ahead of itself. That's the backdrop. Now let's talk about what actually happened this week. On Wednesday, April 1st, silver moved sharply higher in a single session, gaining more than 7% intraday at its peak. The catalyst appeared to be a combination of geopolitical escalation, renewed safe haven demand, and broader precious metals momentum that had been building throughout the first quarter. When risk sentiment deteriorates, capital has a tendency to flow toward hard assets, gold first and then silver, which often amplifies gold's moves due to its smaller and more volatile market. That's what appeared to drive Wednesday's surge. But by Thursday and into Friday, several forces seem to have converged to reverse a meaningful portion of those gains. And this is where the analysis gets more interesting. The first pressure point was the US dollar. When financial conditions tighten, whether through higher rates, reduced expectations for monetary easing, or risk-off repricing in global markets, the dollar tends to strengthen. And a stronger dollar creates real headwinds for hard assets priced in it. This isn't simply a story about foreign buyers paying more at the margin. The more precise mechanism is this: tighter financial conditions reduce speculative appetite for non-yielding assets. As real yield expectations shift even modestly, the opportunity cost of holding silver increases. Capital that was positioned in precious metals as a rate cut trade or a dollar weakness trade starts to look for the exit when those narratives face pressure. That dynamic appears to have been one of the key forces weighing on silver through Thursday's session. The second pressure point was what looked like a broader liquidation event across risk assets. When markets sell off sharply in a compressed window, investors and funds sometimes have no choice but to sell what has performed well in order to meet margin calls, rebalance, or reduce overall exposure. Silver had been one of the strongest performing assets over the past 12 months. That made it vulnerable to being used as a source of liquidity when other parts of portfolios came under stress. This is a pattern you see repeatedly in precious metals. It doesn't mean the thesis is broken, but it explains why even fundamentally supported assets can sell off hard in short, sharp bursts. The third and likely most significant short-term catalyst was the U.S. Nonfarm Payrolls data released on the morning of Good Friday. NFP is arguably the single most market-moving economic release the Fed watches, and for silver specifically, the relationship is mechanical. A stronger-than-expected payrolls number reduces the probability of near-term rate cuts. Reduced rate cut expectations support the dollar, and a stronger dollar combined with a repricing of Fed policy expectations creates real headwinds for non-yielding assets like silver. The March number came in materially stronger than the market consensus, by a wide margin. That appears to have been a meaningful short-term catalyst, adding pressure to a market that was already correcting after Wednesday's outsized surge. With European markets closed for Good Friday and liquidity thinner than usual, any directional pressure is typically amplified. Now here is the part that matters most for the weeks ahead. The short-term mechanics of what just happened don't invalidate the structural case for silver, but they do reveal how fragile momentum can be when positioning is extended and macro headwinds emerge simultaneously. The underlying supply-demand picture remains genuinely supportive. Industry analysts, including the Silver Institute, have been projecting that 2026 will mark a sixth consecutive year of structural market deficit, meaning global demand consuming more silver than mines are producing. These are analyst estimates, and the specific numbers vary depending on the source, but the directional consensus across serious forecasters is consistent. Supply is not keeping up with demand, and that imbalance is not expected to resolve quickly. The reason production can't easily respond to higher prices is structural. A large proportion of global silver output is a byproduct of mining other metals, copper, lead, zinc. That means mine operators can't simply redirect capital to silver production the way a primary commodity producer would. Output is relatively inelastic to price signals, and there are no significant new silver mining projects expected to come online at scale in the near term. On the demand side, the structural case is real, but it deserves a more honest treatment than it often gets. Industrial consumption of silver from sectors like solar photovoltaics, EV manufacturing, AI infrastructure, and advanced electronics has been a genuine and sustained driver of demand growth. These are not discretionary purchases. They are embedded in capital expenditure cycles that unfold over years. However, and this is important, sustained elevated prices do eventually produce a response even in industrial settings. We're already seeing evidence of thrifting in the solar sector, where manufacturers are reducing silver loading per panel through technical improvements. Substitution, while not easy or immediate, is a real risk at sufficiently high price levels. This doesn't break the bull case. The structural deficit is still real, and the transition economy still needs silver at scale. But it's worth acknowledging that industrial demand is not infinitely price insensitive, and the most credible version of the silver bull thesis accounts for that nuance. The physical market signals are worth discussing carefully, because this is an area where the analysis can quickly become either too bullish or too loose. What we know is that there has been a significant movement of silver into US-based vaults over the past several months, particularly into COMEX registered warehouses in New York. The most credible explanation for this, and the one that most institutional analysts have leaned on, is tariff uncertainty. With silver added to the U.S. Geological Survey's critical minerals list, and with the broader policy environment around metals imports remaining unpredictable, there appears to have been a defensive repositioning of physical inventory, moving metal closer to potential demand or delivery obligations to hedge against import tariff risk. This created a basis dislocation between U.S. and global markets. Metal that was sitting in London, the world's dominant spot trading hub, was relocated to New York. That tightened available supply in London and kept lease rates elevated, which is typically a signal of reduced physical availability in the spot market. Whether COMEX inventory levels themselves are a bullish or bearish indicator depends heavily on context. More inventory in COMEX vaults doesn't automatically mean shortage. It can also reflect delivery positioning, futures role dynamics, or arbitrage between regional markets. What it does suggest is that the physical silver market has been experiencing genuine dislocation, and that the supply chain around the metal is under real stress. More broadly, on the supply side, there are export control dynamics in China worth monitoring. China's approach to strategic metal exports has been evolving, and there are reports of tightening administrative controls on certain materials. The precise scope and permanence of any silver-specific restrictions are worth tracking with caution and precision. This is an area where preliminary reports can run ahead of confirmed policy. But the directional concern that Chinese export policy adds a layer of supply-side uncertainty to an already deficit-running market appears credible. So where does this leave the price outlook? In the near term, the market is in a consolidation phase. The key technical area most analysts are watching is in the low to mid-70s. A sustained hold in that zone, particularly if macro headwinds stabilize after the Good Friday data, could set up a retest of resistance in the $74 to $75 range. J.P. Morgan Global Research has published a 2026 average price target for silver of around $81 per ounce, though they've also been explicit that near-term positioning froth needs to clear before re-engaging. That's not a bearish call, that's a disciplined one. Two scenarios appear most plausible from here. In the first, the Fed's posture softens, whether through weaker economic data, declining inflation readings, or explicit forward guidance. The dollar gives back some of its recent strength, and real yield expectations ease. In that environment, silver's non-yielding profile becomes more attractive, speculative positioning rebuilds, and prices have a clear path toward testing the higher range of analyst targets. The structural deficit and ongoing industrial demand provide the floor underneath that move. In the second, the labor market stays resilient, inflation remains sticky, and the Fed holds its higher-for-longer stance through the middle of the year. In that scenario, silver likely remains range-bound or faces further pressure toward the high 60s before finding more durable support. That would not be a fundamental breakdown. It would be a macro-driven compression in a market that still has real structural support underneath it. For investors with a longer time horizon, that kind of correction has historically looked like opportunity rather than catastrophe. What this week illustrated is the tension that defines silver as an asset. It is simultaneously a monetary metal, an industrial commodity, and a barometer of global risk appetite. And those three identities don't always pull in the same direction. When financial conditions tighten and payroll data surprises to the upside, the monetary narrative faces pressure. But the industrial deficit doesn't disappear. The supply constraint doesn't vanish. The structural case doesn't evaporate because one week's jobs number came in stronger than expected. Silver moved from above $75 to the low 73s in under 48 hours. The reasons for that are real: dollar pressure, macro repricing, liquidity dynamics, and a jobs report that the market was not positioned for. But the context around that move matters just as much as the move itself. The metal is still meaningfully higher than where it was 12 months ago. The supply deficit story is still intact across the analyst community. The physical market still shows signs of tightness. And the policy path, while less certain than it looked earlier in the year, still points toward eventual easing, which historically supports hard assets. What happens next will depend heavily on how the Fed communicates through April and what the economic data says about the durability of U.S. growth. Watch the dollar, watch real yields, watch physical lease rates and COMEX delivery dynamics. Those are the leading indicators that tend to move before the price does. This pullback may have rattled some traders. For those watching the structural picture, it looks more like a setup than a breakdown, and that is exactly what we are going to keep watching together. The next few weeks in this market are not going to be quiet. We have Fed communication, more economic data, ongoing geopolitical developments, and a physical silver market that is still showing signs of underlying stress. All of that is going to create price action worth dissecting carefully, not reactively. The moves are going to keep coming. The question is whether you have the framework to read them properly when they do. So if you are not already subscribed, now is the time. Every video on this channel is built around the same discipline. Cut through the noise, read the data honestly, and give you the macro context that actually explains what markets are doing and why. No hype, no permeable silver cheerleading, no doom narratives. Just serious, structured analysis, delivered as fast as the market moves. Hit subscribe and turn on notifications, because the next update on silver is coming the moment there is something worth saying. And right now, in this market, that could be sooner than any of us expect. We will see you in the next one.